Good morning, everybody. My name is Brian Kelliher. I'm a lawyer in an Irish law firm, Dillon, Eustace. And you may well be asking yourself, yes? Okay, thanks. And as I said, you may well be asking yourself, what is an Irish lawyer doing at an alternative investments conference in Mumbai? And you'd be right to ask that question. I guess I should explain that my firm, Dillon Eustace, is the #1 Irish law firm for the establishment of Irish funds. And I'm a partner in the Asset Management and Investment Funds unit. So what I'm hoping to achieve today is to give you a small overview of Ireland as a jurisdiction for funds and why asset managers choose to domicile their funds there. So I'm going to begin with giving you some oversight as to maybe why Ireland. So in Ireland, the first funds that were established were back in 1988. So Ireland has over 30 years experience in the funds industry. And as a result of that, they're internationally recognized as a member of, I suppose, the European Union, #1, the Eurozone by virtue of the fact that the euro is the currency in Ireland. They're a member of the OECD, the Financial Action Task Force, and a member of IOSCO. So they are internationally recognized jurisdiction. Being a member of the EU, importantly, it gives Ireland access to other EU countries. And hence, if there's a fund established in Ireland, the shares in that fund can be marketed throughout the EU, and therefore it's a source of additional, I suppose, capital for funds. It's English speaking, and it's a common law jurisdiction, very common to, or very similar with our colleagues here in India. Highly educated workforce. And I suppose importantly, from a tax perspective, it's a member of the OECD, as I mentioned, and has over 70 double taxation agreements with various countries. The regulator in Ireland is the Central Bank of Ireland, and the regulatory regime is open, transparent, and very much focused on investor protection. So according to Enterprise Ireland, more than 50% of worldwide financial services firms have a base in Ireland. There's innovative fund products ranging from your traditional long-only to hedge fund strategies to alternative strategies, which I'll talk a little bit more about shortly. It's a leading center for the servicing of hedge funds, with over 40% of hedge fund assets serviced out of Ireland. It's also a leading domicile, I suppose, European domicile for European ETFs, with over 60% of European ETF assets serviced in Ireland. And it's a hub for cross-border distribution, with Irish funds being sold in various countries across Europe, the Americas, Asia and the Pacific, Middle East, and Africa. This slide on the screen shows you I suppose, a snapshot of the industry. And it takes into account not just Irish domicile funds, but also non-Irish domicile funds. So Ireland has let's say, an infrastructure of service providers who are servicing also non-Irish funds like Cayman, I suppose Bermuda, BVI, and lots of others. So the services I'm referring to are administration services like fund accounting, NAV calculations, transfer and registrar services. So you can see from this slide that they're overall, from the very top, there's 986 promoters. These are asset managers worldwide who set up these funds and that are serviced in Ireland. And importantly, there's over 500 asset managers worldwide, promoters, that actually are establishing funds in Ireland. This slide shows you I guess, the assets that are serviced from Ireland. And in the very right-hand column, as of June of 2019, there was 2.7 trillion assets in Irish domiciled assets that were serviced in Ireland, with over 2 trillion serviced in respect of non-Irish domiciled funds. Focusing on the Irish domicile funds specifically, of the 2.7 trillion that are actually managed in Ireland, that equates to over 7,500 funds. This slide shows you the rate of growth in Europe in terms of European domiciled, I suppose, jurisdictions. And it's based on the growth of assets, of domiciled assets since 2011. And you can see from the slide that it shows that Ireland is the leading domicile in terms of growth of assets since 2011. So the breakdown of the structures in Ireland, and we generally have UCITS structures, which are your open-ended structures that many of you may be familiar with, to your AIF structures, which can be open-ended, maybe limited liquidity structures and closed-ended structures. So the breakdown of the 2.7 trillion assets under management is 75% of those assets are in UCITS structures and 25% in AIF structures. So it represents around over 2 trillion in UCITS and approximately close to 700 billion in AIF structures. And the bottom left-hand column gives you an idea of the types of asset classes that are in those structures. And you can see that, from bonds, equities, money market funds, alternatives make up 25% of that asset class. I guess the next slide focuses on the legal structures that you have in Ireland, in which I suppose the fund structure is embedded. So like most jurisdictions, you have your corporate structures, like your investment company, and in Ireland there is also a corporate structure as an alternative to a company, which is called the ICAV. It's an Irish collective investment management vehicle. And one of the benefits of that is unlike the investment company, it can tick the box to be treated as a partnership for US federal tax purposes, and therefore can facilitate US taxable investors investing in that structure. Other legal structures are the unit trust and the CCF, which is a common contractual fund. So that's a transparent structure, which many investors who are already exempt from tax in their own jurisdictions like because of the flow through of income and gains. And finally, the ILP, which is the limited partnership. While that has been on our books since probably 1994, it's currently undergoing an update before the Houses of the Oireachtas in Ireland to bring it up to line, I suppose, standard of market practice with ILPs. So that's something we'll probably see rolled out later in the year, which we're all looking forward to, because it is really it's one of the structures, I think, that is you probably mostly see in investment in real economy assets. So the next slide just gives you an organizational structure for UCITS and AIFs in Ireland, and it's assuming it's a corporate structure. So there's a board of directors and there's an appointment then of various service providers. And there's broken lines around the UCITS management company and AIFM, because albeit the trend is that such a party is appointed, it's not a necessary requirement in Ireland. You can have self-managed AIFs and UCITS. So the conference title is about alternative investments. So essentially a UCITS structure is more an open-ended structure where you have, I suppose, liquidity twice a month, so redemptions are twice a month. And the asset classes are really your securities, your transfer of securities, your money market instruments, collect investment schemes, deposits, and derivatives that give exposure to those types of assets. And UCITS it's very popular in Europe because of the passport enables the fund to be marketed throughout the EU. And there's a global brand attached to it because of the fact it's sold in, as I said, 90 countries worldwide. So it's very popular worldwide. It's very popular with Indian managers because of that feature. But the important point is that it's eligible to be sold to retail investors. And consequently, the central bank scrutinizes these products, and rightly so from an investor protection perspective. So there is a timing element involved in having these approved by the central bank. Turning to the AIF structures, the most popular AIF structure in Ireland is one that's sold to qualifying investors, which are your professional investors in Europe and otherwise investors that certify themselves as being knowledgeable and experienced on the types of investments in these structures and on the risks involved. And so these are not designed for retail investors, they're designed for your sophisticated investor. And the other trait is that there is a minimum regulatory subscription requirement of 100,000 euros or its equivalent. So the benefits of these types of structures in Ireland, these QUAIF structures as they're called, because as I said, they're sold to qualifying investors, is the investment flexibility. So unlike a UCITS structure where there's UCITS rules around the asset classes you invest in, the investment restrictions and borrowing restrictions and leverage restrictions, there is no central bank or regulatory specific requirements around investment borrowing restrictions for a QUAIF structure. There's speed to market because of the fact that the central bank doesn't review documentation in advance, albeit it is filed with the central bank and they do random testing after it's authorized. In relation to distribution in the target market, generally speaking, as I mentioned, it's qualifying investors, professional investors, but again, because there's an AIFM appointed, and if that AIFM is an EU authorized AIFM, they equally can be sold throughout the EU, giving managers access to investors throughout the EU. And they're typically used for various strategies. So they can be used for your strategies that you find in the UCITS, and many Indian managers like that because I guess in many ways the UCITS structure can be very constraining in terms of diversification requirements. So you may want to have let's say a long only or traditional or maybe long short strategy in an AIF structure without being subject to UCITS rules. Equally so, though, the AIF or the QUAIF can have closed-ended structures, can have limited liquidity structures where the redemptions are not as frequent as monthly or quarterly. And they are typically used for your private equity, your venture capital, your investment in non-performing assets, and the list goes on. And you can have, obviously, your real economy assets in there as well, in closed-ended structures. So the big benefits from an Irish tax perspective is there's no tax within the Irish fund. So there's no income or capital gains tax. And then importantly as well, there's no withholding tax on any distributions or redemption payments or dividend payments out to non-Irish resident investors. And there's no net asset value tax within the fund as well. On indirect taxes, there's no VAT on the management services, and any VAT that's incurred, that's value-added tax, very similar to maybe your GST tax in India. But generally speaking, there's no VAT on management services. So the only VAT that would arise is in relation to professional service firms outside of Ireland giving advices or services to the fund. And generally any VAT incurred is recuperated by the fund where the assets are based outside the EEA, that's the European Economic Area. And just very quickly, moving away from the regulated fund structures, I thought it would be helpful to also give you an overview of an unregulated fund structure in Ireland that's also used. And this is called a Section 110 company. So essentially, this is a special purpose company. And the reason why it's given a Section 110 is because that's the provision in the Irish Taxes Consolidation Act that deals with the tax treatment. But these structures are used for financing transactions. They're used for investment purposes, such as investing in your private equity, your non-performing assets, distressed debt, credit opportunities. It's very similar to what you'd see on the AIF side in a regulated fund structure. And they're also used in conjunction with AIF sometimes for creating a more tax-efficient structure. The important thing I want to point out about these SPVs or these Section 110 companies is that how they finance the acquisition of assets is by issuing notes. So unlike AIFs that are issuing shares, in these structures they issue notes. And importantly, they're not considered by the Central Bank of Ireland as an AIF structure requiring an AIFM. And the main reason being is that unlike shareholders who have an ownership interest in the company, note holders only have an economic interest or an entitlement to economic participation. These SPVs are subject to tax, taxable at 25%, but they're generally tax neutral because of the deductions from your taxable profits. So the interest on the notes are generally profit participation notes, and the interest on the notes that are paid out to the note holders are tax deductible from your taxable profits. And in addition to other, I suppose, tax deductions in relation to management fees, services, etc., there's very little tax left in these vehicles. Now that's subject to certain conditions, which I've listed in the slide. The main one obviously being tax residency in Ireland, And also, one of the key ones is that more than 10 million must be raised initially in the first acquisition of assets. On the tax treatment, generally speaking, they're very similar to the AIFs in the sense that there's no VAT or stamp duty. And I suppose the big point is in relation to the payment of interest on the notes. And there's no Irish withholding taxes on those, provided that the recipient of the interest is based in the EU or in a double taxation treaty country. And if they're outside of that, they can also avail of, I suppose, no withholding tax, provided it's availing of what they call a Eurobond exemption. So it just means that the notes in the SPV vehicle need to be listed on a recognised exchange. And so finally, my final slide is just to give you an indication of the parties that are generally involved in this type of SPV structure. And you can see that you have your note holders, you have the assets need to be serviced, depending on what those assets are, and you have your cash manager, you have a corporate service provider, and importantly, you have a note trustee as well. So that concludes my brief presentation, and I'm happy I'm going to join the panel and happy to answer any questions any of the audience may have after that. Thank you.